Okay, so let me retweet once more. Hello, good afternoon, everyone. This is Roberto Atush, CEO of Home Research. I'm honored to have here Jay Pelosky for our bi-weekly Musings with Jay, where we talk about what's important, what's moving markets over the next few weeks, and of course Jay's more important calls. So without further ado, I'd like to hand over to Jay. With one question. So as you said, I'm from the government and I'm here to help. So have things changed? Is this now a regime change from what we had for the past 40 years or so?
Thanks, Roberto, and hello everybody in Brazil and elsewhere in South America and maybe here in New York as well. I apologize for my casual attire, but we had some snow today. And Roberto and I were all planning to do something funny with the snow to show all the folks in Brazil where it's nice and hot, the snow in New York City. But sadly, the snow has stopped. So no snow, but Jay and Roberto here to talk markets and talk about the Musings, which, as Roberto mentioned, is something I do every week, every Friday, and now is up on the Home Research platform. And it's really meant to be my best thinking distilled into 500 or so words. So a 2 to 3 minute read comes out every Friday, and we're going to start doing these bi-weekly video sessions together on the following Monday. So I look forward to more of these. And I did start, the title of my piece on Friday was hello, I'm from the government and I'm here to help. And that sounds fairly normal, but in the United States, it carries a certain political connotation because that statement was made by Ronald Reagan in the early 1980s. And he prefaced it with the comment, the 9 most terrifying words in the English language are, I'm from the government and I am here to help. And that really was the guiding ethos of the Republican Party for the last 40 years, to try and shrink government and reduce the impact of government in people's daily lives. And if you think about it, the Trump administration was actually the culmination of this thesis, of this belief, because the idea of the Trump administration, as espoused by Steve Bannon, who was Trump's strategist at the beginning of his 4 years, was the complete deconstruction of the administrative state. So the goal of the Trump term was to basically destroy the administrative workings of the government and to make it clear to people that government could not help, would not help, and therefore people were kind of on their own. And we've seen at the end of the Trump term, we saw the results, in my view, of a strong effort to deconstruct the administrative state, with failures on virtually every level of governance, particularly visible in its approach to the COVID vaccine. The COVID disease and all the efforts from PPE, the lack of PPE, to the lack of testing and tracing, and then to a just completely botched effort on rolling out the vaccine, which now the Biden administration is taking over. So in a way, Roberto, I think we're going to have whiplash. You know, it's such a sudden change, because we're going from the deconstruction of the state to a Biden administration, which is filled at the high level with people with lots of government experience who believe in the power of government. And Biden has, in my view, a much greater opportunity to do big things than many people expect. Most people see him as a moderate. Most people see the Democrat in the Senate at 50-50, and very few, a majority in the House, but by a small number, and see elections in 2 years, and see COVID and joblessness and the economy, all these things piling up, and say there's not going to be much done in the United States. I have a completely different view. My view is that the opportunity to go in a completely different direction is available for the Biden administration. And I believe they recognize this, and they see it, and they're acting on it already aggressively. So as I wrote in my musings, the first effort was to staff the senior levels of government much more rapidly than in the past. So on day one of the Biden administration, they had more people in office ready to go at senior levels of government than the Obama administration did in its first 100 days. So that, first of all, you have the people. Secondly, you have all these huge needs, which are clearly visible. We need to get our hands around the rollout of the vaccine. We need to get our hands around providing stimulus and the rescue package to the American people. We need to get our hands around some of the racial issues and the racism that was so visible over the course of the summer. And to me, what's interesting is that capital is abundant, right? Money is abundant. It's cheap. This administration is making a very clear argument that it is appropriate and right, and it would be kind of a dereliction of duty to not borrow heavily to sustain and help the American economy and the American people recover. So we've had a big effort to staff the government. In the Trump administration, it was the opposite. Many positions were left unfilled. Many positions across the State Department, the Pentagon, Defense, Commerce, Treasury, etc. Half the leadership positions were empty by the time the Trump administration left. So first, people. Second, executive actions. I was at the gym earlier today, and Biden was going on for his third day of significant executive action. So taking action right off the bat. And then now third, recognizing and making the case, visibly making the case. Not only is government good and can help, but it is the right time for the government to step in and borrow heavily. So we're now at a point as market people where the Fed is meeting today and tomorrow. You know, the ECB met last week. Bank of Japan met. Nobody even cares. Nobody even talks about the Fed anymore, because that's not where the action is. You know, the action is in the fiscal side. The action is with an activist government. And there was a quote, Roberto, which I just want to read to illustrate what's changing. So Susan Rice, who's the senior advisor to the president, again, one of the folks from the Obama administration, now senior advisor on domestic policy to President Biden, was quoted as saying, investing in equity is good for economic growth. So they're making the argument that investing in things that restore balance, addressing child poverty, addressing the imbalance between the number of vaccinations being given to white people and the number of vaccinations given to Black and Latino people. That was the graph, and then came on Susan Rice making that quote: "Investing in equity is good for economic growth." So I like the fact that the Biden administration is going aggressively at these issues. I like the fact they're making the case with Janet Yellen that borrowing when interest rates are at rock bottom levels makes a lot of sense. And I think the shift from the culmination of 40 years of Republican ideology to shrink the government to a Democratic administration that says, no, government can help. And then, by the way, the last point, and then I'll stop, is when people get money from the government, because there are millions upon millions upon millions of Americans today who need this help. They're not invested in the stock market, right? They didn't buy Tesla. They didn't buy call options on Tesla. So there's lots of people who need support from the government. And the ability today to generate the data and assess the success of these programs is, again, unparalleled versus 30 or 40 years ago. So Bank of America reported this week that the people who got the latest stimulus checks, their spending on the credit cards, because they can track that credit card spending through the Bank of America system. Spending on credit cards by the people who got stimulus checks was up 13% year over year in December. 13%. The folks who didn't get stimulus checks, their spending was up 3%. So again, the argument that helping people is good for the economy and good for economic growth, I think we're going to hear a lot more of that. And I think the Biden administration has a chance to make the case that activist government is good for economics and good for politics. Because if Biden is successful with COVID, and we can talk about that maybe next, if he's successful in the economic recovery, then 2022, which is not that far down the road in terms of the midterm elections, where typically the new president loses support in the House and Senate, the Democrats have a chance to do better, much better, if they get credit for COVID, credit for recovery. Republicans infighting between Trumpists and non-Trumpists. Big infight there. We could talk about that too if you're interested. And so you have a chance for the Democrats to do better in 22, do better in 24, and you have a situation where after years and years of gridlock, which plays into my whole tripolar world thesis, years of gridlock, you have an opportunity for the American body politic to act aggressively.
No, that's great. And I have a couple of follow-ups. So it's interesting that you mentioned that, while it's really Republican ideology that dominated, the U.S. for the past, 40 years. And, you would say that even during the Clinton years, the ideology wasn't, that much different. I mean, he was forced to, to play ball.
Bond vigilantes, remember James Carville, right? That was the bond vigilante guys. That was that quote. Exactly.
And but the point is, I mean, how much does the market believe that things will get done? And and I'd like to ask you if does the market understand that? Okay, in the past, they thought the gridlock was good because neither party would spend too much, but now, given that there is so much to get done, people's situations are they're simply desperate. And this is simply something that needs a big step. It needs a change in attitude. I mean, how much does the market appreciate that, and or see it as a risk? I mean, how do you see those balancing facts?
Sorry, I don't mean to laugh because sometimes I get on my hobby horse. I was a political science major at school, at undergraduate. So I sometimes get off on the tangent of, government as opposed to, and you're great at like saying, no, wait a second, Jay, come back here. Let's talk about the markets. So I think it's interesting. I think It's kind of too early to tell, I would say, in response to the question of where are the markets and thinking about this. I do think it's a case of whiplash. Again, where and it may not be expressed in the markets as much as like the sudden stop of COVID was a year ago, right? Where the market, everything just stopped. It's not going to be like that. And then we had the kind of the V recovery. I think it's going to be a gradual recognition that that policy of this type is both good economics and good politics will be proven over time, right? Certainly the politics will be determined by 2022 and 2024, right? That's that simple. The economics, I believe it's kind of baked in the cake that we're going to have a very strong year. Remember, my view is a global economic boom. The best growth that we've had in 50 years will come in 2021 and 2022. So I think that's going to be recognized. And where you're probably going to see it, Roberto, is in the fixed income markets, right? Where there's talk of the Treasury, where the Treasury bond is going to go, and does the Fed start to taper, all this type of thing. And I think we talked about it last time, about 10 days or so ago, when we did our first musings together, that one of the biggest mistakes that I think is out there in terms of consensus is where the 10-year Treasury is going to end up. Most people are at 1.2 or 1.3. Some people have started to move it out a little bit now, 1.3, 1.4. But in December, when I was writing my Outlook piece, the consensus for 2021 10-year would end up at 1.2%. I'm in print as of December saying that I think it's going to be between 1.75 and 2%. And I see nothing that suggests that's not going to be the case. And so how the market deals with a higher nominal Treasury rate will maybe determine the reaction of the market to this idea that you can have an activist government that borrows aggressively and has a big fiscal deficit to help the American people get over the hump here. Certainly, I think from the White House perspective, it's clear. And again, I was really struck by this comment by Susan Rice. They're not shying away from it. They're not kind of dancing around it. Clear as a bell, investing in equity is good for economic growth. So I expect us to hear a lot more about that. We'll see how people react to it. I don't think the Fed is going to do anything in terms of tapering. I think that argument that we're going to have a taper tantrum is completely wrong, completely wrong. The Fed is is going to be happy with some inflation. They've already told us, asymmetric inflation targeting is the strategy, AIT, higher inflation to make up for the years of below target inflation. And, we're big debtors, and everybody knows that as a debtor, you like inflation, right? Because it allows your debts. I mean, Brazilians, I think, are probably world experts at the idea of what inflation does to deficits. So to me, it will be more on the fixed income side, but then it obviously, has some impact in terms of the equity and the idea of rotation and all those things too. So we'll see.
That's absolutely right. I mean, and what you guys call financial repression, it was called here in the past, the inflationary tax. That's what it is. The slight difference was that when we had high inflation, Brazilians found the instruments to protect of course the rich people from inflation, which was indexation. But most of the debt in the U.S. is nominal. So as we said before, and globally, so I mean it's fixed debt, not floating rate debt. So I mean, you need some nominal GDP growth, to solve that problem. But
yeah, exactly right, and that's why if you think about the 10-year Treasury at 2%, inflation is going to be over 2%. We're going to have some big inflation prints in the next couple of months. It's baked in the cake because the COVID months of February, March, and April, there was negative inflation year over year last year. So those numbers drop out. You're going to have, headline inflation will be well over 2% in the United States. So the nominal, the real interest rate will be negative still.
Yeah.
So you're not going to have a big effect on economic activity. And to your point about financial repression and the inflation tax, I'll date myself and remind some of your clients that my days in Brazil begin and go back to Fernando Collor and the true hyperinflation when it was, what, 2,000% or something like that, and changing currencies. I started 1990, which was, in dollar terms, as a quick reminder, in dollar terms, the absolute bottom in the Brazilian stock market, 1990. And I was with Morgan Stanley, and we could not get any money to invest in Brazil at that point. It was like pulling teeth to try and get money to invest in Brazil. But that's when my relationship with Brazil began. And it's so wonderful to, continue to that relationship today. But yeah, we're going to have higher inflation in the U.S. It's going to be 2 to 3%. It's not going to go off the charts because you still have demographics and technology and the other things. But we are going to have slightly higher inflation, and I think it's going to be perfectly fine for equity markets. It does reinforce the rotation trade. It does mean that technology stocks, particularly the big ones, are not going to do very well, because remember my argument that rising rates and a vaccine are kryptonite for tech stocks. And I continue to believe that. So even if, like today, for example, even if the US does better than many people think in terms of vaccinations, do better than, let's say, the Europeans do, does that mean that the stock market will do better? And I think you have to be careful, because on the face of it, the answer would seemingly be yes, right? I mean, if you vaccinate more people, economy opens up, stock market should do well. But in the case of the US, with 40% of the S&P being technology, I don't think a reopened economy is good for tech stocks, the big tech stocks. I think it's bad for them. So I think you got to be a little bit careful and keep that in mind when you're thinking about vaccinations and rates and technology stocks.
No, and it's great. And given that you mentioned Europe, that was exactly my next question, because I'm sure you've been following the headlines, today and to some extent yesterday, where in Bloomberg, there were big headlines saying that Europe is risking a total failure where it was supposed to do best, which is it's causing some surprise with slow vaccination rollout. And there's been also this kind of back and forth with AstraZeneca about contracts and everything. So how do you see this? Of course, it's very welcome, the change in tone in the US about investing in people. But, and the main reason why I'm asking this is because of your very bullish call on Europe, which I have too, by the way. So is the change? And as you said, people in the market, they think that Europe can never get anything right. So will they, fix, and change the course of things?
It's again a great question. I was on Bloomberg Monday morning, so yesterday. Last week. Sorry, I'm getting my days mixed up. It's been super busy. But anyway, I was asked the same question by one of the anchors there. Kind of pushing me on the European view. And my view is, to be clear, is that we're in a rotation. And one of the rotations is away from the U.S. to the non-U.S. markets for leadership. And I think this is, the U.S. has been the only game in town for over a decade, since the bottom in 2009. I think we're in the early stages of changing that to non-U.S. leadership. And part of that leadership, I believe, will be from the developed markets, so Europe and Japan, and as well as parts of EM, which we could talk about later. But in terms of the developed markets, it's Europe and Japan primarily. And the thesis is that they're cyclical economies, they're trade-heavy economies, both Japan and Europe and Germany in particular, tied very closely to China. I'll just make as an aside that Japan in December had its first year-over-year growth in exports in over 2 years. And there's more trade data in Asia that we can talk about. Maybe we'll talk Europe now and then maybe a little bit of Asia and China. But so Europe has been disappointing. It is worrisome. I will definitely agree and admit to that. I haven't changed any allocations. I don't envision changing any allocations because I do expect that the Europeans will get this figured out. I'm a bit surprised, as many are, that it seems to be off to such a slow start. I mean, if you look, for example, the US, I believe, through the other day, have vaccinated about 7 per 100 people. And the UK is about 10 per 100. And Israel, which is the leader, is at like 42 per 100. So almost half the population already. The Europeans are at 2 per 100. So lagging badly. And there is issues, as you say, about AstraZeneca and their supply and production shortfalls. So it's worrisome and it needs to be addressed. But I would also point out in defense of keeping one's positions, should you be invested in Europe or as I am overweight Europe, I'm underweight US equity, overweight non-US equity in a global multi-asset portfolio. So just to be clear, what we're talking about is that if you look at the recent data, the production side of Europe is doing fine with PMIs over 50. So they have figured out, as have many other places, how to produce in a COVID age. The consumption side, the service side is obviously struggling, but it's not horrible. It's much, much better than it was in March and April, even though the lockdowns are very strict. So again, the human beings are learning creatures, and we have learned how to deal with COVID to an extent. And so to me, the bullish case for Europe, very quickly, is they deal with the vaccination issues and they start to vaccinate with like everybody else and they move forward. But the really bullish case is that through a combination of their 7-year budget, the Joint Recovery Fund, and the Green Deal, Europe has a 3 to 5 to 7 year macroeconomic runway that is pretty well set. And China is doing its 5-year plan, which we'll hear more about in a month or so. But this is part of the reason why I think the US can't afford more gridlock, because Europe and Asia, the other two poles in my tripolar world thesis, right? Europe, Asia, and the Americas, the 3 poles of the tripolar world. Europe and Asia are moving aggressively. And the US and, broadly speaking, the Americas, including South America, including Mexico, are not moving aggressively. And it's not we're not in a vacuum. We're playing a relative power game. And there are big things happening that make me feel as an American that we need to have an activist government to move forward. Europe, I think, is integrating. You just listen to the language again. What do you hear when you listen to European policymakers? You hear the term strategic autonomy. That was not a term used 3 or 4 years ago. And so one of the challenges for the Biden administration is to understand it's not 2016 again. It's not 2012. The world has moved on. Brexit and President Trump have shown the Europeans that they need to develop strategic autonomy, the ability to play off the Chinese and the Americans. And you see that even when Europe agreed to their investment deal with China a week or 2 before Biden was inaugurated. That would have never happened 4 years ago, 8 years ago, 12 years ago. It happened, 3 weeks ago, 2 weeks ago, because of this desire in Europe to gain more strategic autonomy. And so to me, Europe is a cyclical stock market. It's a cheap stock market. It's relatively underinvested. They have strategic, big picture plans around climate, around the recovery fund to enhance their integration. And I think just to put the final touch on it, that their ability, or now their desire and ability to issue joint debt to fund the Green Deal is a huge change from the past, and sets the stage for joint taxation around things like carbon and technology, a digital tax, which then leads you to think about things like a common banking union, common deposit insurance, and then bank M&A. And that's something, again, I think we touched on it last time, but I'm very bullish European banks. And I think that that's an area where we're going to see significant changes over the next couple of years for the better. And those banks are trading at less than half of book, several of them. So very, very cheap.
Yeah, great points. And I mean, I also think that they'll and there's actually summits planned for them to address the vaccine issue. And it's just as an issue of economic growth for them. It's a reputation and what the European model stands for. But even if there is a delay, and what you said about Asia and in the cyclical markets make total sense. But my question is, does it make sense? If you have an European overweight position initially, in the trade. So let's say to be more overweight in markets such as Germany and Sweden, which are more cyclical markets, big exporting economies, and then later on you go into markets such as Italy, Spain, where you have like 12 or 10% of GDP being tourism. So as people begin to have more faith in the reopening and vaccination, then you go into these economies which are more service oriented, and also France, for instance.
Yeah, I think that makes sense. I mean, the way I'm investing is more broadly through kind of a broad European ETF, where the question is whether or not you include the UK, because some of them do not include the UK and some of them do. And I know the UK is now, with Brexit, no longer part of the European Union, but it's part of Europe and arguably part of these ETFs. And so the one that I'm invested in is the one that includes the UK, in part for some of the bank exposure, in part for some of the industrial and mining exposure that is offered through the vehicle as well. But yes, I think Germany makes sense. I like the banks. I think the peripheral markets are, as you say, probably the second stage. And I would just note, for all the angst about Europe, Italy's government just fell and nobody blinked. Whereas again, 2 years ago, the spreads with the German Bund would have blown out. People would have been selling the heck out of the banks. EUFN, the European bank ETF listed here in the US, is up over 1% today. I mean, again, 2 years ago, 3 years ago, when all the talk about populism and Italy following the UK out and all the rest of it, those days are gone. It's a different mindset, in large part because people learn and people see the model and they see, and if it works, then you do more of it. If it doesn't work, you don't do it anymore. And that whole argument was tried for several years and is no longer a valid argument, I don't think. And so now it's European integration to compete with a rapidly integrating Asia, and leaving open the question of what is really the purpose for the Americas. And even go so far as to say, thinking about COVID and the vaccinations, I know that in Brazil, the principal vaccine is a Chinese vaccine. In Argentina, the principal vaccine is a Russian vaccine. Again, would have never happened 10, 15 years ago. Would have been an American vaccine. Yeah. And still would be. To me, there's a real opportunity for the hemisphere of the Americas to integrate and start to size up to compete with an Asia, which is integrating rapidly, and with a Europe that I believe also is seeking strategic autonomy, recognizing that Brexit, the UK had to pay, and they will pay, and they have paid. No one wants to leave the European Union anymore. That discussion has been completely put to bed. So, tactically, you can make a case for Europe or not. Strategically, over the next couple of years, to me, I think Europe has a very good chance, as I've said before, of winning the 2020s in terms of thinking over the next, multiple set of years.
Absolutely. And linking to your point about strategic independence, I mean, a lot of people would think that, the first, opportunity, for that to, the show would be against China, but I guess it's Russia. So, and the issue of Nord Stream, because, Biden just said that, it was literally like 10 minutes ago, he said that Nord Stream is a bad deal for Europe. And we know that, the guy who's most likely to replace Angela Merkel is pro-Russia. He wants to reset our relations with Russia. So, I mean, of course, the issue of European energy is highly complicated. But, I mean, I don't know if that's something which you have a view on or affects, your whole investment, thesis. And just to complement, it's not just people that don't want to leave Europe anymore, but now there's the issue of Scotland, that, if the Scottish National Party wins, and depending on how big they win, they will likely look for a new referendum because they want to be part of Europe. So that may be, just, another, a headwind for the UK.
Yeah, and those are the things that are going to continue to kind of play out. But to me, that's more of like a tempest in a teapot. With the big case being European integration, what happens to the United Kingdom is now going to be an issue more for those for the UK than for Europe as a whole, and that's the way it should be. So for me as an investor, I'm not spending a lot of time thinking about that. With Nord Stream, also, to be honest, not spending a lot of time thinking about that. My European energy investment is through a clean energy ETF, where that to me is really the exciting opportunity. Though I will note that several big brokerage firms have started to upgrade their European traditional energy, the Shells and Totals and others, who have potentially significant dividends, and I am and certainly have been for the last several months making the case that you could make money as an investor both in clean energy and in old energy, and that has been the case. XLE and clean energy ETFs like ICLN or QCLN have both done phenomenally well over the last 3 months, up about 40% each. I prefer at this point the clean energy ones, both in Europe and in the United States. But maybe switching gears a little bit and talking about Asia, I do think what's happening in Asia, particularly on the trade side, is really compelling and worth paying attention to. Not only the China growth story, which is pretty well known and pretty well flagged, but I mentioned Japan's exports up year over year for the first time in 2 years. Taiwan's exports in December were up 40%. I make these points in my musings, put down these figures so you can see them when you go look at the report. But South Korea's exports in the first 20 days of January were up 10% year over year. And a large part of this is due to the semiconductor shortage, which is manifesting itself all around the world. And so one of my big tech positions, in terms of not really all that excited about the FANGs, is in the semiconductor space, which if you read the press, and I tweeted out one of the stories today. Again, folks, more than welcome to follow me at Jay Pelosky on Twitter, where I highlight some of these articles I see. But TSMC was talking about raising prices for the second time this year, and talking about a chip shortage that's going to manifest throughout the course of the year. They're running flat out as we speak. And so there's going to be shortages of semiconductor chips, which then brings into question, Roberto, the whole idea of splinternet and the separation of tech stacks, right? We have told the United States under President Trump, basically told the Chinese, you guys should not trust us to provide you with any materials that are necessary for you. So naturally, the Chinese, again, if you read the stuff, and I spend a lot of time reading, folks ask me, like, what's your process? How do you do your thing? I read. I'm a reader. And I have developed over the decades of work lots of sources that I know are good and understand where they add value. Yeah. And those are the folks that I read. So if you read the China stuff, it's all about self-sufficiency. It's Europe is strategic autonomy. China is self-sufficiency in technology. In the US is investing in equity is good for economic growth. I think if you think about those three phrases, that will give you a lot of guidance as to how and where one should invest, how one should think about things. So China in Europe and Asia more broadly, particularly East Asia with South Korea and Taiwan, that's really a tech story, and I like that story. And so I think that's an area where I continue to focus on. I think there's a lot of opportunity throughout Asia, but it's also very similar to what you said about the peripheral countries in Europe, because then you have ASEAN in Southeast Asia, and that's where the global consumption growth is going to be. Asia and Indonesia is the global consumption story. Europe is going to be kind of the regulatory power in technology and in climate. Again, the US and the Americas still searching for what is going to be the purpose. I really, honestly, because that's how I think about each region and then how they interface and then how it affects the whole world. And so to me, it's consumption in Asia, regulatory structure in Europe, and I still struggle with the Americas, but lots of opportunity, I think, in Southeast Asia on the consumption side. And one of the ETFs I like a lot is this EMQQ, which is the Emerging Market Internet and E-commerce ETF. It has a number of Brazilian companies in it. It has Stone, for example. It has Mercado Libre. It has Yandex in Russia. It's a great vehicle. It has
thanks. It's a great one. Yeah.
Yeah, it's done really well. So, it's not in the first innings of this trade, but I think, one of the things that I think is going to drive EM and makes it so different than EM in the past is EM today is a tech is a tech centric index, where before it was an industrial or financial index.
Commodities,
yeah. And so EMQQ is in the whole tech stack in China, because I do think splinternet is real. We are in this semiconductor shortage, in the privacy issue with Twitter and Trump and other things. Those two things, the semiconductor shortage and the privacy issue and social media, I think are just reinforcing that push to self-sufficiency, where people are going to want to have their data, they're going to want to have their hardware in terms of chip production and things of this nature, and they're going to want to have control over who sets the rules. Because for years we've been listening to, China censors the internet and they have their big firewall. Well, gee, we just in the United States, we just took the president right off social media like that. And so, I mean, it's when again, thinking about things like that, then thinking about, okay, if there's going to be a tech stack in Asia, how do I best play that? If there's going to be a tech stack in Europe, where's the opportunity? If there's going to be the tech stack in the Americas, who's the beneficiary? And by the way, I think we're getting the same thing in currency too. And I'll stop here after a second. But the renminbi in Asia, the euro in Europe, the dollar in the Americas, and now we're starting to hear about a digital coin in China. A digital euro was mentioned in the ECB meeting last week.
Yeah.
So, you know, these are the things to be thinking about, because the big opportunity set is not only in the global economic boom and the great rotation and the golden age for asset allocation that those three things generate, but it's also the thematic investing, right? And maybe we could spend a minute on that. My thesis of COVID speed breaking out into climate and other areas.
You know, and it's a coincidence, because that was exactly my next question on thematic investing, and the one related to climate. You know, a lot of people think that, you know, the ETFs that you have just mentioned, they have already run too far. But, you know, people don't understand, you know, things such as what you say, you know, the COVID speed. And I would like you to comment on BlackRock's statement today about, you know, pressuring companies. They're simply saying they are going to divest companies which are not, you know, net zero by you know, 2050. And if they want to be net zero by 2050, you know, they have to start acting now. So I mean, of course, you know, we could have a whole session of this, but, you know,
yes.
I mean, what do you make of such statement?
No, I think you're absolutely right, and it's funny. It's funny you mentioned BlackRock, because you could talk about BlackRock for two things, in my view. Right? Today was Larry Fink's letter, which gets a lot of publicity on climate and net zero, focusing on companies, pushing companies. But then the other comment was a day or two ago, where they announced that they are going to allow several of their funds to invest in Bitcoin derivatives, Bitcoin futures that are cash settled. Their global allocation fund, which I thought was really interesting, right? Because that's kind of what I do. Now BlackRock is blessing the idea of putting crypto into your asset allocation process. Now, they're 3 months or so behind me. I wrote about this several months ago, so not bad for BlackRock. If you want the cutting edge stuff, you come to Jay. But I thought that was also fascinating. And the other fund that they said that they'll let have Bitcoin exposure was in their strategic income opportunities fund, which I didn't really understand why. That didn't make a lot of sense to me. But the global allocation one makes a lot of sense. And just to start there and then work back to the climate, I do think that in terms of COVID speed breaking out, and what do I mean by COVID speed? Quickly, the speed of the spread, the speed of the policy response last spring, the speed of the market reaction, the speed of science, which generated a vaccine in 1/10 of the time that it normally takes, and then speed of delivery. Hopefully the vaccinations needs to pick up, but that delivery speed is what we're talking about now. And I've extended the thesis into the idea that COVID speed is now breaking out to other areas like climate, because we've seen the model, right? The model of cheap, abundant liquidity and capital combined with global intellectual capital focused on a single idea can create amazing speed. And we've seen that with the vaccine. And we're going to see it with climate, to your point, Roberto. And crypto and fintech is another area, as is genomics, as is cyber. But I think the one that really hits the mark is climate, because it's global. Everybody's focused on it with this net zero, right? In the last 3 months, we've had China, Japan, South Korea, and the United States all commit to net zero by 2050. And you're absolutely right that the market is trying to figure out what that means in practical terms, so it can value some of the vehicles that are there to participate in that view. And so I think this helps explain some of the frenetic activity we're seeing in certain parts of the market. It helps explain kind of the SPAC phenomenon, the blank check phenomenon in the United States, where people are putting together the blank check company and then finding some sort of hydrogen or a fuel cell or charging stations or what have you, something climate related, to fund and drive innovation and accelerate and shorten the time frame to making profits, to making a product, to being successful. And so Larry Fink, I think the article there, very interesting, because this is happening from the bottom up. This is happening. Investors are pushing up. BlackRock's an investor, forcing companies to act, and the companies in turn are pushing governments. And it's happening all throughout Asia. If you look at Japan, if you look at Vietnam, if you look at Thailand, companies are telling the countries that you have got to provide us with green energy, or we cannot set our next plant in your country because our shareholders won't allow it, because it will mean that our supply chain is not green enough for them. So this is just really fascinating stuff that it takes a lot of time to think about. But I'm very bullish on climate and green energy. Very bullish.
No, I still think, people in Brazil, and looking at Petrobras and what they're doing, they really underestimate what's going on. And I guess another big evidence was I think last week Elon Musk said he would give talking about big checks, he would give $100 million to
that's like $5 to you and me. For him, $100 million. That's like $10 from Jay. I'll give you $10.
Yeah. For the best, for the best carbon capture technology. So I think what we're going to have is a very healthy competition of who wants to beat the 2050 or 40 or whatever targets they have. And I mean, as you said, if the US wants to go to net zero, that means in 2030, not 50 but 30, half of the vehicles need to be electric, and then what that means for batteries and the whole supply chain. So that's something 100%. People do not understand, what's, the speed of things.
100%. I mean, I own BLNK. It's up 28% today because Biden said he was going to make all federal vehicles electric.
Yeah.
Part of it is that Blink is really the only way to play that right now. It's the only publicly traded charging company. Some point that's not going to be the case, but for now it's a question of so much money into so few vehicles have dramatic price swings and moves that we're not used to seeing lots of things move 5, 10, 15, 20% a day. It's pretty wild, and really for me, and maybe we'll finish here and then see if there's any questions, but for me, as an investor, as a global multi-asset investor and advisor, I'm spending a lot of my time not only thinking about the traditional equity, bond, commodity, alternatives allocations and geographic allocations, US, non-US, EM, DM, etc., but also this thematic piece.
Thematic allocation.
How much of that portfolio should be in the thematic piece? How much should be in climate? How much should be in cyber? How much in innovation and disruption, genomics, fintech and crypto? Those are like my big five. And that's where I'm spending a lot of time. And I'm kind of settling in around somewhere around 20 to 25% or so of the total portfolio in those in that thematic bucket, which is made up of those 5 or 6 different themes. Because when you have that kind of volatility, you've got to really size things properly. Because you have a 3% position that's up 25% in a day, it throws out, your whole portfolio gets moved around, and which, that in this case, obviously good, but there are going to be days when it's down 10 or 15%. So a lot of it is really thinking about the future and positioning for the future, and positioning and understanding that the speed is not going back to where we were. I like it. I make it akin to like going down the highway. Typically in the U.S., the highway speed is 55 miles an hour. Yeah. We've gone to a 65 to 70 mile an hour zone, and we're not going back to 55 miles an hour. So to me, that reinforces the importance of thinking forward and projecting forward. And that's something, frankly, that I think I do a reasonably good job. I'm very much trying to always focus forward. You'll rarely see stuff about the past in my work, my writing. It's much more about the forward, what the outlook is, and thinking about things like the tripolar world, splinternet, and thematic investing. So I'll stop there, Roberto. Maybe we have a question or two, or maybe you have one more. I know we're getting close to the hour.
We have questions. Some people sent me questions before. So, and also in line with what we wrote in the Musings. So I guess the last point, and also talking forward, you're pretty optimistic on the earnings season on the S&P. Mm-hmm. But talk about surprises. Korea had a surprise GDP number today, and and I guess it's part of your whole Asia consumption story, mm-hmm. And the fact that that's where consumption is. So I guess we can discuss if Korea should still be an emerging market, but that's that's MSCI's problem. But
Henry Fernandez at MSCI is a good friend of mine. He and I were together at Morgan Stanley back in the day when MSCI was nothing like it is today. He's the CEO and has done a phenomenal job there. I don't know when they'll graduate South Korea, but I do think that that the consumption story in Asia is very big. The tech story is very big. As I said, the semi chain in South Korea and Taiwan and China. But in terms of the earnings, and finish maybe just on this idea of mini rotation, because we had the last 3 months, we had the rotation from growth to value, from US to non-US, from defensives to cyclicals. All that worked phenomenally well. It was a fantastic last couple of months. Now we're ending the best 3-month period for the US, the best 3 months of the year. Just ended this past week. I think of the 25th of January. This is more a technical kind of mindset, but I do pay attention to technicals in these markets. And so we're now entering February. In February of election, post-election Februaries are the worst month of the year historically, going back the last 70 years. S&P average is down 1.5%. In February's post-election years. So we're exiting a very favorable seasonal period. We're entering the worst month of the year seasonally, historically, and we're kind of having a mini rotation out of the things that worked for the last several months back into things like big cap tech and the S&P and the NASDAQ. And to me, this is all very healthy because we have a market that's broad enough and big enough in terms of its move up, both in terms of the US and globally, right? The number of markets around the world that are up, the number of stocks that are up in the S&P, the breadth thrust that we've seen mean that you can have these overbought and overextended conditions worked off by time, not just price. And working off by time is much better because it doesn't scare people. When you have to work something in overextended, overbought market by price has to drop quickly. That scares people. Here we're talking about a stealth correction in technology where the FANGs did virtually nothing from October to 2 weeks ago. They were one of the worst performing segments in the US. And now they're having a little bit of a pop, while the value cyclical non-US stuff takes a break, and then we're going to go back, and it makes sense because of where COVID is and the questions of vaccines, etc. So to me, a mini rotation, very healthy, working off overbought conditions by time rather than price, very healthy, suggests further upside over the course of the next year or two. Stick with, in my view, the non-US cyclical value stories. If they sell off a little bit, that's your opportunity to add to them. Still bonds in a bear market, particularly U.S. Treasury government bonds, bear market. Commodities, very bullish. And I think in the case of crypto, it's really going to be the institutions like the BlackRocks that are saying we can now have it in our portfolios. They're going to drive the price structure of the crypto assets going forward.
So that's fantastic. So right on the hour, I would like to thank you, Jay, once again. It was a great discussion, fantastic as usual, and remind our folks, our audience, that next one is going to be on Monday, February the 8th at the same time. So 4 p.m. Brazil time, 2 p.m. New York time, until New York changes time, but it's going to be 4 p.m. Brazil time. Maybe next one we can. I mean, of course, we'll see what's in the musings and what's relevant. But there's a lot of stuff we can explore, such as how do you go about constructing a thematic portfolio, because that's something not a lot of people are used to. So thanks, Jay, reminding people that this is a bi-weekly event. We had it today because it was a holiday in São Paulo yesterday. So now every other Monday at 4 p.m. at Home Research, Twitter and YouTube channel. So thanks again, Jay, and have a great week, and look forward to 2 weeks from now.
Excellent, Roberto. Thanks again. It's great to be with you. Great discussion, and yes, very much looking forward to doing this on a regular basis and continuing the discussion. We're in for interesting markets. I'll just say one last thing. I plan to write my monthly this week. Probably going to be titled Whiplash, after what we talked about today, and it should be up on the home site on hopefully on Friday. So
that's fantastic. Thanks again, and we'll talk soon. Thanks, everyone. Bye.
Thank you. Bye bye.
Cheers. Bye bye.